If you think that government spending is going to boost growth and improve productivity and improve your real wages, you better think again. The reality of the past 2 decades is that monster increases in government spending and a constant chain of stimulus packages have delivered nothing but stagnation. However, there is always somebody out there that thinks that things are going to improve because this time is different, and it is not. In this first graph, what we can see is what we have lived in the recent past is fundamentally just rate cuts. Yes, we have seen a few rate hikes, but mostly market participants and economists have only seen in the past 2 decades easing, monetary policy easing, fiscal policy easing, with central banks becoming the lenders of first resort, not of last resort, and with governments becoming the engine of spending that leads to that secular stagnation that I mentioned before. We'll understand why in the last graph, but let's look at the next graph, which tells us why it was so imprudent to cut rates so quickly coming from the Federal Reserve. The Federal Reserve already panicked in June of 2024 when it decided to slow down the path of normalization of the balance sheet, i.e. print more money, because the 2-year government bond, as we will see now, went through the roof. More importantly, the Fed has been panicking because it cannot control fiscal spending, and fiscal spending is leading to secular stagnation. And secular stagnation is exceedingly bad for the middle class because it erodes real wages. It gets the families and businesses that could lead to higher growth and improvement in the economy to suffer more, to get worse off situations, being unable to make ends meet and being unable to grow. But what this shows is that there was no need to cut rates in 2024, particularly in the last September cut, when the financial conditions index was at its most extremely loose level seen in years. Okay? So think about this. A massive rate cut added to a panic with the normalization of the balance sheet and a previous panic with injections of liquidity. All of those tell you that the Federal Reserve, that central banks are not there to curb the insanity of fiscal policy, but to disguise it, as we will see in the next graph. If you look at the next graph, what we can see is precisely that, is how the Federal Reserve panicked step by step. Number one, increasing liquidity injections when the 2-year government bond yield started to rise with inflationary pressures, with completely insane fiscal spending and out of control deficits. Number two, it decided to panic yet again with the reduction in the pace of normalization of its balance sheet, i.e. printing more money, when the 2-year government bond reached 5%. It obviously generated through financial repression a reduction in the 2-year government bond, but that placebo effect started to fade out just before the rate cut, and that's where it panicked the third time. Number one, liquidity injections to support the regional banks from collapsing. Number two, the level of liquidity injection that means reducing the pace of normalization of the balance sheet in June 2024. Number three, a rate cut. That is basically all done to disguise the disaster created fiscally by the government. Let's go to the next graph, which shows us what happens after rate cuts. Well, it depends if there's going to be a recession or not. That's a difficult one to call. Why? Because it's very easy to disguise a recession. In fact, the United States is in a private sector recession, as proven by the earnings and sales of the Russell 2000, as proven by the reality of small and medium enterprises, and as proven by the reality of families in consumer confidence. But if there is no recession, the average increase in the S&P 500 is about 10 to 17% after a significant rate cut. If there is a recession, a decline of between 15 to 20%. But that has to be a serious recession, a 2008 style recession, not what we are likely to see. Why? Because it's very easy to bloat government spending and debt and disguise GDP. We have already seen it. The largest discrepancy between GDP and gross domestic income in history, about 700 billion. Let's go to the next graph, which shows us that the rate market is already pricing a recession. Yes, obviously it is, because the private sector is in a recession. Small and medium enterprises are losing sales and they're losing in earnings. But more importantly, their margins have not recovered. Families all over America are suffering because of the rise of prices. And more importantly, they tell you that inflation is coming down, but nobody is seeing that decline in energy prices or that decline in shelter that allegedly we see in CPI, i.e., the worsening of the position of families is very, very evident. So, private sector recession, my friends, pay attention to it. Let's go to the next graph. If we go to the next graph, we see why you should not bet on more government spending to boost growth, because it doesn't. The only thing that the United States has seen with massive increases in government spending has been the following. A massive reduction in the bang for your buck. There are some investments, there are some public investments that do generate a real economic return. But the reality of what we have seen in the last 2 decades is that bloated government spending only generates stagnation and secular stagnation. For every new dollar, according to this graph of Bank of America, for every new dollar of public debt injected in the economy to quote-unquote boost growth, how much do we get out? Less than 50 cents. Less than 50 cents. That is atrocious. And the government has 3 limits. Limit number 1, economic limit. Bang for your buck is worsening year after year after year. More government spending means less growth. Number 2, a fiscal limit. The level of interest expense, even with the rate cuts, is leading to more spending on interest expenses than on defense. About $1 trillion in interest expenses. Number 3, the inflationary limit, which shows that a country that is producing more oil than Saudi Arabia, a country that has the best technology giants and more competitiveness and higher productivity than its peers, is actually suffering from more than 20% accumulated inflation in the past 4 years. The government has literally destroyed the private sector in order to bloat government. That is the reality of the United States, and that is what can lead to the destruction of the confidence in the US dollar. That is why it's so important to recover the confidence in the US dollar and the confidence in the US public accounts and stop this insane deficit spending spree. Keep defending freedom. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.